don't buy a property expecting something extraordinary to happen for you to
Yeah.
make money.
Hmm.
Appreciation is the extraordinary thing.
Yeah.
That's not the normal thing. Appreciation is capital gains. It's not operating income. Okay.
Yeah. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey everyone, today I've got Jason Hartman. Jason, how are you doing today?
Good. How are you?
I am excellent. Excited to have you on the show. And a little bit about Jason. He's been involved in several thousand real estate transactions, owned income properties in 11 states, 17 cities, and his companies have helped people achieve the American dream of financial freedom by purchasing income producing properties nationwide. And so, a bit more, Jason's got a podcast, Creating Wealth podcast, educational events, referrals, mentoring, all kinds of stuff that he's doing in the industry. Just a ton of awesome stuff, Jason, that you've been doing in the industry for a long time to really help people out. And of course, you've got your own stuff going on with your own real estate investments. So a lot happening there. Give our listeners a bit more about kind of your background and we'll dive in.
Yeah, so I've been helping investors buy properties and build portfolios nationwide for 21 years now. And I've been podcasting for 20 of those years.
Wow.
And we've just got a ton of educational content. What I've really tried to do, Todd, is not rehash all the old stuff that everybody's been saying. Ever since I was 16 years old, I've been reading real estate investment books, going to
Mm.
seminars, going to conferences, and doing all of that stuff, like hopefully we all do. But I really try to come up with truly original ideas that have come out of my own head, out of my own experience, and I'll share some of those with everybody today.
Yeah, you started in real estate. What was it? At 19?
Yep, I was 19 years old, first year of college, and I started selling real estate for Century 21. And I bought my first investment property when I was 20. I actually bought it from one of my
Wow.
own clients, a guy that I had, driving around in my little Volkswagen Jetta at the time. I had a few investor clients my first, 6 months into my career. And one of them, his name was Jim Wool. He bought a few properties from me, and there was one property he didn't like very much, and he said he wanted me to sell it for him. And I said, "Hey, I don't want to sell it for you. I want to buy it from you." So that was my first deal.
Nice.
And what's interesting is that as business people, as real estate investors, we all face lots of challenges and lots of bumps in the road. And my first rental property that I was managing myself at 20 years old,
Yep.
I had to evict the tenants. It was what most people would call a bad experience, right?
Yeah. Yeah.
And I would have been completely justified in giving up by then. Hey, I tried this real estate thing, it didn't work
Yeah.
for
Doesn't
me.
work.
But boy, am I glad I persisted, because I see so many investors, so many business people, just life in general, they just give up too
Mm.
easily.
Yeah.
One of the
Yeah.
things you've got to do is, to achieve success, you've got to be just doggedly persistent. And so that's a really, really important thing.
Yeah, I think for every real estate success story there's probably, a dozen people that say, oh, it's all about tenants, toilets is trash, and all the negative stuff you hear, which yeah, certainly there's definitely negative things. You got to evict your first tenant,
What isn't,
and
what things don't have
yeah,
negativity? What worthy pursuit in life can anybody do
that's the
that
key.
isn't going to be plagued with problems?
Yeah.
Okay.
That's the key. If you're going to try to do something a worthy cause, something that's going to, be a positive effect, it's going to have a ton of negative, aspects around
Yeah.
it. And you have to, as you said, be doggedly persistent.
Yeah. You're getting paid to overcome obstacles. That's
Yeah.
what you do.
I love
Yeah.
that. So today, so 20 years you've been doing the podcast thing
Yeah.
before anybody.
Yeah, before anybody knew what a podcast was, I know
Yeah.
I'd say that to people, and I'd have to explain it to them, and it was really annoying to have to explain it. But I've got, for my main show, the Creating Wealth show, I've got over 2,200 episodes now. And there's just a wealth of free content that anybody can take advantage of. So, check it out. It's all there for you. Certainly nobody can use the excuse anymore that they don't have the information.
Yeah.
They may not
Yeah.
have the motivation, but they certainly have the information.
Yeah, 100%. It's out there, and you do have to sift through it a bit. And that's maybe the biggest challenge is, as a new person, it can be really overwhelming. How do you, like, what do you talk to people about that are trying to get started? Like, because it's just, you can go on to YouTube, you can go on to podcasts, you can go like everywhere, and there's just millions of pieces of content. How do you focus on one?
Yeah. Yeah, no, that's true. Just find find someone you relate to that helps you understand things, that isn't giving you a sales pitch every 2 seconds, and follow them and just learn from them. That's what I would recommend.
Are you currently buying right now, Jason?
Not at the moment. I am doing deals, but I haven't purchased a property directly lately. I'm kind of in a different mode than most of my students. It's not because I think the market is actually quite fantastic. I think there are the demographics coming at the rental market, at the housing market. There's definitely a housing shortage. I can go over a lot of that data with you. It's not any thought because of the market. My own personal life, I read a book a couple of years ago called Die with Zero, and I realized that I'm way past the point of wealth accumulation, and I need to be, which he aptly says in the book, I need to be focusing on spending down my wealth. Okay, like literally. I mean, spending. I know some people listening say, "Oh my God, I can't believe this guy. That's ridiculous." Hashtag first world problems. Look, I grew up poor. I made it. I worked hard, and you really have to spend your money well is a job, and it's a challenge. I'm not kidding. Like, to get the highest lifestyle reward out of spending, which is just another tool. It's just money. It's just a thing. It's no big deal, but it is important. Is really something that takes some real focus. Unless you want to get addicted to gambling, cocaine, and hookers, or have a couple of marriages that go bad. You could spend your money that way. Any of those will destroy your wealth quickly. But to be conscientious about it is, that's a real task. It really is.
I imagine, I mean, you're an entrepreneur that's been driven his whole life. You're not just doing nothing though, right? I mean, you're still.
Oh no, I'm doing a lot of things. I got a lot of businesses. I'm actually starting a new business, which I'm pretty excited about. But it's more at a certain point. It's really more of just the game. Okay. I mean, I definitely do not need any more money. Okay. One of the interesting things about this, a lot of financial planners have gotten behind this whole Die with Zero book and the idea of it. And, depending on where you are in your journey, when you're listening to this, you can just go search. I mean, don't Google it because that's an evil company, but DuckDuckGo it or something and type in Die with Zero calculator. Okay. And in these calculators that different financial advisors have come up with, put your net worth, what return you expect, your life expectancy, and it'll basically show you how much money you need to spend every month to die with zero. Okay. And, a lot of people think, oh, well, I have kids. I don't want to die with zero. I want to leave them something. That's not what the book's about. That's just the title. Okay. He explains that. He goes into all of that. But the point is that most of us, including myself, okay, spend way too long on this sort of script, which is, chase the next rabbit. Right. And it's that book really taught me that, I don't need to keep chasing rabbits. I'm done with that. Like, there's a point where you got to like wake up and stop, right? And do and think more conscientiously about it. Okay.
Is that the book he talks about pre-giving inheritance? Is that in there?
I don't remember him saying it that way, but he does talk about that as a concept. And so, for example, the I want to leave money to my kids type of idea, right? Which, number one, if you leave too much money to your kids, you're probably going to screw them up. Okay, that's the first problem. Okay, so everybody needs to realize that spoiled children do not do well in life. Okay, but number two is that why would you give your money to your kids when you die?
Yep.
Why not give it to them when you're alive? If
Right.
your kid wants to start a business, why don't you help your kid start the business and capitalize it for them? And you can be there to guide them and to coach them. You want to wait till you're dead,
Right.
right? And then they're not going to have your guidance. They're not going to have the benefit of your experience. And guess what else? Probably you're going to die when your kids are in their 50s. And hopefully by then they got their act together and they've got their own money,
Yeah. They
right?
don't need your money now.
Yeah. So, if you want to give your kids a hand in life, like help them when they're in their 20s and 30s,
Yeah.
when they're in the growth stage, right?
Yeah. 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 How nice would it have been with your journey and mine, and probably most people listening, is if their parents gave them, let's call it even $500,000 when they were in their 20s. Of course, if that person's driven, right? If I was given, you started investing when you were 20, if I was given 500K when I was 20, I wouldn't have been responsible enough for it,
Yeah.
right?
Yeah. Well, and you don't
25, I
necessarily
was.
give them the money. You
Right.
help them set up a business.
Right.
Okay. You're
You
not going to
help
give them the
them.
money. You're going to help, you're going to give it to a company, a business. You're going to
Yeah.
form a business or buy a business or something like that.
All right, let's switch
Or
gears. I
buy
want to
some
dive
investment
in.
properties and build a portfolio. It
Yeah.
could be anything. Yeah.
Yeah. I mean, that'd be fantastic, right? I want to dive into, you talked about,
But let me just make the point there. Sorry, because I want to make sure people got the point. You asked me if I was buying properties.
Yeah.
I think it's a great time to buy
Yeah.
properties.
That's what I want to dive into.
It's not the best time ever. It was certainly better a few years ago. Okay.
Yeah.
I mean, I hate hearing these, bullshit people that say, oh, there's never been a better time to invest. Certainly there was a better time. Okay.
Yeah.
There were lots of better times. But it's like the old saying, what's the best time to plant a tree? Well, 20 years ago. What's the second best time? Today.
Yeah.
You got to just get in the game. Okay.
Yeah.
There's never a perfect time. Look, when I bought my first rental property, interest rates were high. We were coming off a major recession. Okay. Nobody would have said it's a great time to buy real estate, right? But I made money on that first property, even though I had to evict the tenant. And then it was just great from there. I mean, I just made so much money investing in real estate over the years. And, I think it's the most historically proven asset class in the entire world.
I saw a post the other day, and I didn't fact check it. I don't know exactly how true it was, but it showed the
you could
U.S.
just have Facebook do that for you.
It was a Facebook post.
Their fact checkers are reliable.
Yeah, exactly. Yeah. Yeah, Facebook and LinkedIn. It was either a Facebook or a LinkedIn post. Anyways, it showed real estate throughout the years for the last, I think it was 72 years back. And it showed the years that real estate has had a negative declining year. And there was 5 years. 4 of those were during the great financial crisis, right? From 2008.
Which was the worst economy in 7 decades.
Right.
Okay?
Worst economy we've seen.
All of these idiots out there are stuck on, oh, this is a repeat of 2008. No, it's not. It's not even close. The characteristics of our economy now are just completely different. I mean, anybody who thinks that is just an idiot. Okay.
Yep.
They're these doomers that put out all of this clickbait crap on the internet have just been wrong. And I'm not saying they'll be wrong forever. A broken clock is right twice a day, as the old saying goes. And, they'll be wrong someday, but here's the problem. I mean, look, they've been saying there's going to be a market crash, forever. There's always people out there saying that. But I can certainly remember people saying that big time in 2011 and 2012. Okay. After we were coming out of the Great Recession. Yeah. And guess what?
Double dip recession. How many times did you hear that?
Oh,
we're going to have a double dip recession.
In 2011, 12, 13, 14, 15, 16, 17, 18, 19, 2016, it was, the business cycle's been going for so long. Oh my God, Trump, it's going to be a disaster, and then, Biden, it's going to be a disaster. And then COVID, it's going to be a disaster. Mm-hmm. Everything's a disaster with these people. Okay. And look, the human mind is programmed to look for negativity because throughout our evolution for zillions of years, negativity could kill us. But today, we live in an abundance of environment. Ever since the Industrial Revolution, that has changed. It's not the same game, yet our minds will take a long time to evolve, right? We are now in opportunistic world where there are lots of things you can do. But let me also speak to this. You said you looked at that chart that showed that there's only been a few down years, right?
Yeah. Yeah.
Sure, great. But look, here's the other problem. Anybody who thinks that investing in income property is about prices have an extremely shallow view of the market. It would be
True.
like Kamala Harris, right? She's an idiot. Okay. I mean, let's just face it. Even if you're a Democrat, like
Hmm.
she can't do an interview, she has no coherent thoughts. It's truly shocking that this person could actually run the world. I mean, it's truly shocking. But, that's a shallow view of real estate. Income
Yeah.
property is a multidimensional asset class. And you make money in so many ways. You make money from cash flow,
Yeah.
from my trademark strategy, inflation-induced debt destruction, from tax benefits, from being creative and adding value. There are so many ways you can make money. Leverage makes money. Talking about prices is like, seeing the tip of the iceberg that's above the water when most of the iceberg's below the water.
Yeah.
Okay.
I like
Uh,
that.
so it's just not enough information.
Yeah.
And there's such a focus about prices, prices, prices. Just take this idea, for example. Think about it. When prices are soft, the whole culture is unmotivated to buy. Okay. Right. Would you agree with that?
Oh yeah, for sure.
Right.
For
People
sure.
are thinking, why should I buy a house? Prices are soft or they're going down, or it's flat, like there's no urgency to buy. But guess what? If they're not buying, they're renting. So there's upward pressure on rents. When
Yeah.
prices are going up, rents tend to soften more because everybody's moving from the rental pool to the ownership pool.
Yep.
So there's always ways to make money. Viewing it as a price only thing is extremely shallow. Okay. So price is just one of many dimensions.
Well, and that's how you get into trouble too, is just focusing on the price. I mean, how many people got in trouble right before the great financial crisis
Yeah.
because they were just buying on price appreciation and they said,
Right.
well, I'm going to buy this. I don't care if it's losing me $150 a month,
Yeah.
no big
You're absolutely,
deal.
or 150, 1,000 a month,
1,000, yeah.
1,500 a month. I
Yep.
mean,
And
people
they're
in
looking at the tip of the
California,
iceberg, right?
yeah,
And then,
yeah.
and then they hit it.
Right. Don't buy a property expecting something extraordinary to happen for you to
Yeah.
make money.
Mhm.
Appreciation is the
Mm.
extraordinary thing.
Yeah.
That's not the normal thing. Appreciation is capital gains. It's not operating income. Okay.
Yeah.
You want to just be there as like a dividend investor. That's the best way to go. And so we divide the country into three types of markets: linear markets, cyclical markets, and hybrid markets.
Hmm.
And linear markets, we think, are the best markets into which to invest. So, my company, Empowered Investor, we help clients buy properties all over the country in different markets that we like. And those markets change, right? It's a dynamic thing. Like, a few years ago, we would recommend a different market than we'd recommend today, right? And so we've always got a few markets that are the good ones at the time to enter. Right, the people who are already there that already own property, they're just in cash flow mode, and they can just keep their properties and get a nice return off them every year. But linear markets, if you're looking at a price chart, since we're talking about price, are boring. Nothing extraordinary happening. These are markets like, well, most of the country's a linear market, okay, but the ones we like now: Alabama, Indiana, a little bit of Florida. Florida's getting a little sketchy in a few markets, definitely. Texas has been great, but Texas is getting a little bit challenged.
Yep.
Some of these
Yep.
markets got a little bit over their skis, and so they're retrenching. It's minor. It's nothing big, okay, but just a little bit. And so that linear market, if you look at a price chart, it just goes up very steadily. It's got little bumps up, little troughs where prices go down a little bit, but overall it's just a consistent kind of slow and grow thing. It's the tortoise and the hare.
Yep.
The cyclical market, which are all the trophy markets you hear about all the time: the West Coast, the
Yep.
expensive Northeastern markets, South Florida, where I happen to be. Okay, these expensive markets are cyclical. If you look at a price chart, it's ups and downs, ups and downs. It's a roller coaster.
It's exciting.
And those markets, yeah, it's exciting. It's newsworthy. So they get all the media attention. And there's big swings, but those markets have terrible cash flow. They tend to be landlord unfriendly, and they're just not the right places to invest.
Yeah. Those are the markets that you'll do great when you hit that right spot of the cycle. But if you keep on going, you're gonna get caught. And
cyclical markets are for people who get lucky and speculate and gamble. And once in a while, gambling and speculating, you get lucky. It's just the way it goes. But and they seem like geniuses, but they really are just lucky. And linear markets are for people who are value investors. They would follow more the Warren Buffett philosophy, right? Where they just get in the game and they're consistent and they stick with it for a long time. That's the type of investor I am.
When you talked about you talked about inflation busting, like explain what you mean when you talk about inflation and real estate.
Yeah, absolutely. So I created a strategy years ago that I call, and it's a mouthful, it's called inflation-induced debt destruction. Okay, I know that's a mouthful. And for those watching on video, I'll just share my screen because I got some visual aids to go with this one. Can you see that okay?
Yeah, I got it.
Okay, great. So inflation-induced debt destruction is the idea that you borrow money against inflation-indexed assets like real estate. And you pay it back over the long term, and inflation comes along and debases the debt. Okay, this is the hidden wealth creator that really makes people wealthy in real estate. A lot of people think, well, hey, I bought a house for $300,000 and I sold it for $400,000 and I made 100. Not really. That's a shallow understanding, okay? Because what happened is that, if you got a loan for $200,000 and at the time of sale, inflation has debased the value of that debt, okay, because you borrow at today's dollars, you pay back at tomorrow's cheaper dollars that are inflated away, and you have inflation-induced debt destruction, which is an incredible thing. Let me give you an example. So what we're basically doing here, Todd, is we are shorting the dollar. That's the whole idea, short the dollar. I'm long on real estate. I'm long on pretty much everything I own except one, and that's the US dollar, which I am shorting. Now, compared to what? That's an important question. In fact, I say that all the time because I think it's life's most important question. Compared to what? Compared to other currencies, the US dollar does pretty great. But compared to actual hard assets, the US dollar is being debased like crazy. So it depends what you're comparing it to. Okay. But you do want to short the dollar against commodities. And, we've got a huge spending problem in this country. We've got $35 trillion plus in debt. It's increasing at $3.6 trillion per year, $1 trillion every 100 days. It's insane. It's insane. There's no way we can pay back the debt. I've identified 6 ways to get out of the mess. The government could default on its promises and say, sorry, there's no more money, we overspent. Very politically unpopular, not going to happen. We could raise taxes, but you cannot raise taxes enough to solve the problem. There's no mathematical way to do that that'll work. We could sell off our assets. Remember, just over a decade ago, we were talking about selling the ports to Dubai. The Bureau of Land Management sells off land to real estate developers. We sell military equipment to countries we probably shouldn't sell it to, our great technology. Toll roads are owned by foreign countries within the US. Okay, so we do sell some assets, but we could sell more to get out of the debt problem. We could use our military to steal the assets of other countries, and we've certainly been accused of that. On the good side, technological innovation, artificial intelligence, biotechnology, nanotechnology. I mean, there's incredible technological things happening in the world right now, and that could solve the problem by just creating general prosperity. But the most likely and for sure thing that they're going to do, which is the thing they have been doing for decades, is inflate the debt away. So what I'm suggesting to your listeners is that they follow the same exact business plan that our governments and our central banks are engaged in already. This is nothing new. It's nothing complicated. Think about it this way. If you're the United States and you owe 100, or say you're the US and you owe $1 trillion to China because there's a trade deficit, right?
Yep.
And so the US is the biggest debtor nation in the world, and it has the reserve currency of the world. It's in a very unique position that other countries cannot enjoy. If you have 10% inflation on a debt of $1 trillion, now the 10% could happen in 1 year or 2 years or 3 years, it doesn't matter, just 10% happened.
Yep.
Now the value of that debt has been debased.
Yep.
It's declined.
Yep.
You basically got a $100 billion discount on your debt.
On your debt.
It's an incredible strategy, and we can do this with real estate so well. Inflation-induced debt destruction. So I got a couple pointers for your audience, but you might have a question now, so I didn't want to keep rambling.
No, keep going. Keep going. This is great.
So, there's two kinds of policies that our government engages in when it comes to money. Fiscal policy, which is taxing and spending, and then monetary policy that's controlled by our central bank, the Federal Reserve. And that's essentially money printing or quantum, QE, right? Easing the supply of money or making the supply of money harder to get to, which is, we've been in a tightening phase the past couple of years, and it's been pretty tough. A lot of people are complaining about it. In the early 80s, the Fed chair at the time, Paul Volcker, put us into a really tough tightening phase. And that's why we saw interest rates at 18 and 20%. Yeah. It was insane. But he broke the back of inflation. And that's what Jerome Powell is trying to do gently to create what they call a soft landing. Yep. And he may have achieved that reasonably well. I mean, it wasn't super easy, but it wasn't devastating either. And now the Fed is talking about pivoting and changing their policy to ease the money supply now, to soften it, right? And mortgage rates are very low. Well, I mean, they're not the COVID era rates, but they're
still relatively low.
Yeah, it's the lowest it's been in like 2 years almost. So here's why to get excited about monetary policy. To understand inflation, we need to distinguish between the real value of something and the name of something. So, let me grab my wallet here, okay? And for those of you watching on video, you'll see this, okay? So here in my wallet, I happen to have a $100 bill, okay? Oh, you can't see too well with my virtual background, but that's a $100 bill, okay? And if I ask you, Todd, what is this? Tell me what your answer is.
$100.
Yeah, exactly. Yeah. And that's right now I'm asking you that question. Yep. But what if this was 30 years ago? in 1994.
Yeah, it would still be $100, but it would certainly go a heck of a lot further, right?
Right. And that's the difference between nominal. Nominal is the name of something. It literally means in name only. And real is the value of something.
Yeah.
So there's a difference between the name of something and the value of something. And so this is what we do with our debt. And this is how we get inflation-induced debt destruction. So inflation is the insidious hidden tax. It's a hidden tax that destroys purchasing power. Inflation destroys the value of our savings, our stocks, our bonds, and actually our equity in real estate. But thankfully, it also destroys the value of debt. And that's why I always like to say debt is my favorite four-letter word. Because inflation destroys the value of debt. And I'm going to show you a real-life example. This is not a theory. It happened to tens of millions of people. I'm going to show you an example in a minute. Inflation is the most powerful method of wealth redistribution because it redistributes wealth from lenders to borrowers, because lenders loan money at today's value and borrowers pay back at tomorrow's lower value, so they get a break on their debt. And it also it redistributes wealth from old people to young people. Now, why would that be, people ask? Well, because old people, hopefully and mostly, have savings, stocks, bonds, and equity in real estate, and young people tend to have debt.
Yep.
And so without anybody dying, without any inheritance occurring, there is an automatic intergenerational wealth transfer happening every minute of every day through inflation. Okay. So let's look at a real life example. There's a lot of numbers on this chart I'm showing. And for those listening on audio only, I'll just explain them. But what I'm showing here is an example of someone like, millions of people who bought a house in the 70s. And in this example, they bought this house 1 year after Richard Nixon took us off the gold standard. And the median home price in 1972 was just over $18,000.
Wow.
If they put 20% down, they got a mortgage for just over $14,000. And the interest rate back then, I know some of you think the rates are high today, but the interest rate back then was 7.37%. And that was completely normal.
Yep.
Okay. And they got a 30-year mortgage. Now, when they started out, their mortgage payment was $101 per month. That was the payment on a $14,000 and change loan at 7.37%. But that was 1972 when a dollar was worth a dollar.
Yep.
But by 1984, hey, George Orwell wrote a book. You all got to read it. 1984. If you already read it, read it again, because it's literally happening. All his predictions are coming true, unfortunately. Yeah, scary, scary stuff. So by 1984, the 1972 dollar that was borrowed is now only worth 40 cents. Wow. A lot of inflation.
Wow.
And the person in this example was still writing a check every month to pay their mortgage. And the check was for how much? $101.
Right.
But that check felt a lot lighter. The amount on the check said the same for 30 years. Every month for 30 years, it said the same $101. But it only felt like $41 by 1984. Okay. Now, what happens at the end of the story? Let's fast forward to the end. The 1972 dollar is now worth 24 cents. The mortgage payment is now equivalent to $24.
Wow.
Okay. And this person and millions of others just like them basically got paid to live in their house. Okay. Because recapping, they borrowed just over $14,000. They repaid with interest just over $36,000, about 3 times the mortgage. That's the typical amount, almost. Yep. And the real dollars after inflation debased them was $16,000 and change. Okay. But remember, mortgage interest is tax deductible.
Mm-hmm.
So after tax deductions and inflation-induced debt destruction, they only paid back $12,655. But Todd, they borrowed $14,614. How can that be? Well, that's inflation-induced debt destruction.
Yeah.
So they thought they were paying 7.37% on their mortgage. After inflation-induced debt destruction, they were paying 1.06%. And after inflation-induced debt destruction plus mortgage tax deduction, they paid negative 1.16%. They literally
actually made money.
Paid to borrow.
Yeah.
Okay. And they lived in a house for free now. But wait, there's more, as they say on that late night infomercial. Okay. But wait, there's more. Remember, this was with an owner-occupied home. If this were a rental property, they wouldn't have paid any mortgage. The renter would have paid it.
Renter. Yep.
So the returns are literally infinite. It's the most incredible investment ever. That income property is the most historically proven asset class in the entire world.
So how would you tell somebody, because debt can be a powerful tool, but it can also be a very destructive tool.
Yeah.
So what would you caution people or tell people, suggest that are listening to this and going, I love what Jason just said. How should I maximize my loan? Do I get the biggest loan possible? What do I do?
Look, leverage is like nuclear weapons. they have to be treated with respect. Okay. And, some would say that, I mean, we all saw the movie Oppenheimer, last year, whenever it came out. And, now the story is widely known. I mean, I knew the story before the movie, but, a lot of people didn't. Okay. And some said, don't you feel guilty, Oppenheimer? You've invented the thing that could destroy humanity, destroy the entire world. And then, others would say, look, that is the best thing that I invented because it has prevented wars,
Yeah.
right? Because it's a deterrent.
Yeah.
Okay. And so leverage has to be used with respect. Okay. It is a powerful tool, but you should not use leverage with things that do not produce income or things that depreciate in value, right?
Yep.
So your properties generally, not always, but generally appreciate in value, and mostly they produce income. Okay.
Yep.
Anything else is consumer debt, and consumer debt is bad. Okay. But I, now that I showed you this little secret, it's not as bad as you think, even consumer debt, right? Because you get inflation-induced debt destruction with it. The problem is people tend to overspend and they spend on stupid things and they get into trouble with that, right?
Right. Yeah, I think the biggest key there is make sure you're making money on your real estate. Like if you're getting the loan so big that you're not making money, it's still not a good deal.
Like, well, I would even play devil's advocate with you on that. Okay?
Oh boy.
Because think about it. In this example we just did, Todd, they didn't make any money on it. They just lived there.
I'm saying if it's your rental property, it's your investment.
They got a free house. Right.
Yeah.
If you had a property with negative cash flow, okay, say you were literally supporting the property, right? Mm-hmm. Okay, you could still make money. Okay, now it depends how much you're supporting it. Okay, and usually negative cash flow is the result of one of two major things. Number one, you bought in a cyclical market where you shouldn't have bought, and you expected appreciation, and you took a big negative cash flow because you just knew it was going to appreciate and you were wrong. Okay, imagine that. That happened to a lot of people. Or number two, part of that, this is like a part A and B of that same thing. You got a divorce. And divorce is such a big destroyer of wealth, not always because she took all my money, which is certainly one thing, but it also forces people to liquidate assets at the wrong time, at inopportune times. That's what divorce does. So it can be very bad in that way. But the other problem is that you got debt against a consumer item, right? And that's why you got into trouble, right? You either expected appreciation to happen, you had to liquidate at the wrong time. These are the areas people get into trouble with debt, okay? But if you're in a linear market that's conservative and you manage your properties well and you keep them rented, you're probably going to be in pretty darn good shape.
Yeah, I generally agree with that. Yeah, we just watched a local guy here that went through a divorce, and unfortunately, multifamily properties at the kind of the bottom of the market, he had to sell a bunch of them, liquidate, and I'm sure he still made money because he's owned them for a long period of time, but sold during the worst time because of that.
Look, folks, one lesson out of this show today: time your divorces.
Or marry the right person.
If it's the wrong time to liquidate assets, go to counseling, make it work until the market comes back, and then you can get your divorce. Okay.
Or just marry the right person in the first place.
Well, you never know who's the right person. That's the problem. It's amazing. I would never go into a business deal the way people go into a marriage.
That's true.
It's just, there's an Andrew Lloyd Webber song, and it's got the lyric, "Love makes fools of everyone," and don't be the fool, folks. Okay, it's a dangerous proposition. There's no bigger destroyer of wealth than divorce usually.
So on that same topic, not about divorce, but on that same type of theme, what's a mistake you've made, and how can you teach our listeners from that mistake?
Oh gosh, one mistake? I can't.
Just
I don't
one.
know if I can even drill it down to one.
I know.
There are so many.
Yeah.
But the thing is, with this whole mistake question, is anything really a mistake? There's that old
No,
saying, like a
no.
lot of the new age people like to say, there are no accidents, right?
Yep.
Because, you had to learn something. And a lot of times, and I don't know what it's called, but you've probably heard it, a lot of speakers, or it's in books, this story that's been revised a bunch of ways, but it's about some Chinese farmer or something. And,
Yep.
you
I,
know, you know
maybe.
what I'm gonna say, right? Yeah. Where can I find that? I gotta find that one because
Yeah.
yeah. Yeah, but it's
Yeah.
like, okay, his dad gave the kid a horse, and he was
Yep.
so happy. That was good. And then he rode the horse and fell off and broke his arm. That was bad. And then something else happened, and that was good, and that was bad. That's just
And
the
when
way
people
life
came up to
goes.
him and said, "Oh my gosh, your poor kid, he broke his arm,"
Right.
and the dad said, "Maybe."
Yeah.
And then because he broke his arm, he couldn't get drafted, I think, into the
Into the war,
war.
right? Yeah. So it
And
saved his
people
life.
are
Yeah.
like, "Oh my gosh, your kid is so lucky," and he
Yeah.
said, "Maybe."
Yeah.
So
Yeah. No, I know. Look, this is the way life goes.
yeah.
And there's a one of the things I say to my listeners and my audience on the podcast and YouTube is watch the movie Yes Man with Jim Carrey,
Mm-hmm.
because most people in life just say no too often. Now, granted, you can certainly be reckless and say yes too often
Yeah.
too. That
Yeah.
there's a balance here. But mostly I think it's people who say no too often. And what Yes Man shows you is kind of that flow chart, if you will, that you were
Yeah.
describing, just with the horse and the breaking the arm, and didn't get drafted into the war because he had a broken arm, right? And that's how life is. It's like this funnel or flow chart, right? Where we're kind of moving through these things. And a lot of things that I thought was bad or a mistake I made really turned out to be a blessing in
Yeah.
disguise. So, just learn to go with it and take the punches. And you're either there to learn something. The point is to just survive and keep going, because there's a tremendous wisdom and a tremendous power in momentum. And the only person that can really break the momentum most of the time is you. It's the person in the mirror. And you break the momentum by giving up. And
Yep.
it's just, I used to train real estate agents, and I owned a traditional real estate company that I ended up selling to Coldwell Banker years ago. And I just saw time after time, I saw real estate agents just give up as the dam was about to break and things were about to start working for them when they just gave up.
Yeah.
So don't be that
So
person.
powerful.
Yeah.
Jason, you've given us a ton of time, so I really appreciate that. I got two last questions before we wrap
Sure.
up.
Yep.
A favorite book you can recommend to our listeners?
Oh God, there are so many great books. You know, I think The 7 Habits of Highly Effective People is just a great one.
Love that book.
But more recently, The Rational Optimist by Matt Ridley is fantastic. That book is so good. So you wanted one book, I'm going to give you a few books. Die with Zero, that I started talking about. I think that's good, but that it depends where you are in your journey. We're all in a different place. Okay.
Yep.
So Die with Zero, if you're starting out, is not the book to read. Okay.
Yep.
Because you got to go make some money first.
Yeah. You already have zero.
Yeah, you already have zero. So you don't need to learn about dying with zero. Another great book that I'm reading now, which is a more of a culture study book, is called The Parasitic Mind by Gad Saad, who's a professor that talks about these crazy, woke ideology and how it's just destroying the world, which it certainly is. Gosh, there's just so many good books. Yeah, I don't know, Sapiens by Yuval Noah Harari is great. The Psychology of Money
That's a
by
good one.
Morgan Housel, that's
That's a
fantastic.
fun read.
Yeah, The Untethered Soul by Michael Singer for a more spiritual book is really good.
Man, you can keep going. You got a whole list.
Oh yeah, I mean, I
There's a
consume,
lot of good stuff out there.
yeah, I try to consume about 200 audiobooks per year.
Wow.
I used to read a lot
Wow.
more, and what I'm finding, and this is terrible, I hate to even admit it, but I think we're all suffering from this. My attention span is just getting just decimated by the way the media comes at us and the way life comes at us anymore. But I do read a lot of articles and newsletters, but reading a whole book anymore is not something I do often, sadly.
Yeah. Yeah.
Yeah.
I'm kind of the same.
I
I've got
used
this.
to. I used to do it, but
Yeah.
I just don't as much anymore.
Yeah.
Yeah.
Yeah. I think you're right though. It's just the way of the world and it's the way
Yes.
things are going. So, all right. Last question. What are your three pillars of wealth creation? Three pillars.
God, you didn't give me any time to prepare for these
That's
questions.
perfect.
I mean, gosh, Kamala Harris in the debate, she got all the questions in advance.
Yeah,
So
but
you can't even give me that courtesy, huh?
it's not it's got to be off the cuff. That's the best thing. 'Cause I just want to see what pops into your brain.
Okay. I think the first pillar has got to be leverage.
Mm,
Whatever you do, you must get leverage. And this is, of course, real estate is great for leverage because we
yeah.
can use debt, we can get inflation-induced debt destruction. Archimedes, the philosopher and mathematician, said, give me a lever long enough and a fulcrum on which to place the lever, and I will move the entire world. And that's literally true, right? You
Yeah.
could literally do that
Yeah.
if the lever was long enough. And
Yeah.
that's what leverage does. So always try to have leverage, but the leverage isn't always in the money. Sometimes it's in the psychology. You've got to get leverage over yourself,
Mm,
over not giving up, over persisting in tough times. And there's all kinds of points of leverage, but
yeah.
leverage, I think, is
Yeah.
definitely one of them. I think the next one, although it's part of leverage, is to influence as many people as possible. So if you are, I mean, look, it's obvious what people do in media and influence, right? But
Yeah.
say you're a real estate investor or a real estate agent, for example, right? What you want to do is have as many opportunities to potential sellers that are going to sell their property, where you can do a deal with them, you can do a wholesale deal, you can buy it from them, you can do creative financing, you can do seller financing, whatever, right? You've just got to have more contacts. An old saying is, for salespeople, the more contacts you make, the more contracts are
Mm,
possible.
yeah.
And so you've got to be known and have connections with more people,
Yeah.
right? And that's a
Yeah.
form of leverage too. Okay. And I don't know what else is there. Certainly, you've got to protect your assets. Okay, that's very important. We help people do that at Empowered Investor. By the way, we provide referrals to the right attorneys that help with this. And as part of our pro membership, we have private Zoom meetings on this and all kinds of stuff. And you've got to protect your assets and create structures to protect your money, because as soon as you start making money, people are going to try and take it from you. That's just the ugly way the world is. The U.S. is a litigious place, and
Yep.
you've got to set things up well so you have firewalls.
Yeah.
So you could lose something, but you can't lose everything because you've divided things up.
Yeah. Yeah. Love that. Love it. Jason, well, you did excellent off the cuff, by the way. You didn't need any prep for that. And I really appreciate you being on the show. Appreciate your time. Thanks for taking a lot of time with us today. How can our listeners get in touch with you?
Yeah, my pleasure. First of all, I love teaching and helping people because I was a struggling beginner at one point, and so
Yeah.
those it's really the most fulfilling to help those people. Like it's
Yeah.
great to help rich people too, but it's like more fulfilling to help the beginners, right?
Definitely.
Because you
Definitely.
can really see a difference, right? Like, a rich guy, like someone asked me the other day, what if I give you $10 million? Well, I don't, I have more than 10 million now, and I'm not, it's not going to change anything,
Yeah.
honestly.
Yeah.
It really won't. And so it's great to contribute. And I think everybody just, if you're far along on your journey, give back and help others on the
Mhm.
journey, because that just makes the world a better place. But my main website is jasonhartman.com. Follow me on all the social media like Instagram. I post a lot of good stuff there at Jason Hartman and the number one on Instagram. But my podcast, The Creating Wealth Show, you can just type my name on any podcast
Yeah.
platform.
Yeah.
Look for me on YouTube, subject to censorship, sadly, but that's where you can find me.
Awesome. Awesome. Jason, again, it's really been a pleasure. I really appreciate it. And you have a fantastic rest of the day.
All right, you too. Happy investing, everyone, and thanks, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.